Hi folks, Scott here, and this is the wrap for Thursday, May 2nd. So tomorrow is the monthly jobs report. Our daily worksheet, which I call my TGP worksheet, today's gap play worksheet, will be posted as soon as I'm done with this wrap by 6 p.m. Eastern Time or so, and it'll include data for day of the monthly jobs report, which is a very important day. But what I'd like to focus on right now is to show you the results of fading gaps after this unique two-day pattern, specifically fading gaps after an unfilled up gap. So the white line was today's open, and you see the big spot or space between the lows of the day and the blue line. So today's up gap did not fill in this 5-minute chart, nor did yesterday's down gap fill. So a little bit unusual, actually a very unusual two-day pattern. And I ask yourself before I show you the data, do you think this is a bullish or bearish setup? Meaning, you think buying down gaps or shorting up gaps has been more profitable historically? I will be the first to admit that my gut tells me this is a bullish pattern. Right? You have an unfilled down gap completely reversed by an unfilled up gap. However, as often is the case, and I have tons of experience, but I'm wrong as well. That's why I crunched the numbers. Check this out. So again, it's only happened about 30 times in the past 10 years. Odds do favor a gap down, which I guess even by definition you could say that's a little bit bearish, a little bit surprising. But look at this, only 67% win rate, a little bit less than the historical average of 70%, and it's been a money loser. Now granted, a big chunk of that was one trade, so I wouldn't necessarily call this overly bearish. It's certainly not bullish though. However, look at up gaps. 9 of 11 up gaps I've filled using an end of the day stop. Now I don't use end of the day stops, but it's a good place to start your analysis. And I'd have to say that this is gives a nod to selling in the short side tomorrow. As always, I'll defer to our gap guides and further evaluate the setup before I make my final decision. All right. Today there are several things in play. I'll show you the worksheet, which averages up the 8 gap guides. A gap up, which is what we have between the high and the close, has been historically slightly attractive. Even drilling down further into the guides, which I'm not going to go into right now, but if you look at the specific guides and the zones, it was the DOC zone. You can check out our gap zone map on our homepage if you aren't sure what zone that is. But the DOC zone actually is normally an okay zone, or can be a very good zone, maybe a better way to say it, but only 4 of the 8 met my criteria today, so it wasn't quite compelling enough. And in terms of unique day factors, day after Fed day is historically, let's call that neutral overall. But what's interesting, an up gap after an unfilled down gap during a bullish market is surprisingly weak. These are weak numbers. Pi factor 1 means it's break even historically and only a 50-50 play, 55% win rate. So, but I'm on the fence. I'd look at other analysis, anything else that may be unique. This was finishing up last night's wrap, which I do every day, or try to do every day. That wasn't any help, just sort of a neutral scenario after an unfilled down gap that closes below the 2 days prior. But what was interesting, most of the pre-market was pretty volatile, and we were set up to open at or above 1582, which is the 40% of the 5-day average true range level. A real key area, great delineator for delineating large gaps, which will generally have lower win rates than the small and mid-sized gaps. And during bullish markets, these have been bad, less than a 50% win rate, only slightly profitable. So I'm looking for at least a 60% win rate and a 1.3 profit factor. So it doesn't meet my criteria. I ran an optimization looking at different percentages of gap fill using stops equal to different percentages of the gap size, and none met my criteria. A little bit unusual. I ran 16 different scenarios. Just no edge, just no insight there whatsoever. It's been very unpredictable in the past, and so that's basically what I said here. Guys, it's neutral to slightly attractive, but we see some risk factors for fading up gaps. Market is clearly unstable and has not been conforming to historical probabilities for the past few weeks. If you haven't been paying close attention to my videos, if you have, you would have seen, as I promised, the good, the bad, the ugly. We've had a lot of ugly of late, but it does happen once or twice a year. Good news is it is normally short-lived, as last year proved. I think March was terrible, and then I just more than made up for March last April. And September was terrible, and then we slated in the fall and even the first quarter this year. So it just goes in these ebbs and flows. You have to hang in there with good money management and just follow your plan and take a long-term view. Nonetheless, there was nothing worth trading today, or as I said, there was no clear and compelling, historically based justification for fading today's gaps at the open. I'll wait for my range guys to take my cue from them. So that's what I did, and that was a great call. White line is where we opened. Blue line again did not fill, rallied, and then consolidated all afternoon. None of these indices filled. Whoops, let me get this over here. NASDAQ ripped to the upside, putting in new highs. So you just look at the white line or the lows of today's action versus the blue line. None of these gaps filled. 15-minute range guides didn't show any edge in either direction, but the first hour guides did. Check this out. This is what you're looking for, folks. You have to recognize these. You need to be selective, but when they're as good as they were today, you've got to be trading these. High breakout, using a 4-point stop, 4-point target today, clearly was the favorite trade for the ES. See the average of the three different systems for the high breakout, almost 60% and 1.3 profit factor. Now for the range guys, because these are completely uncorrelated systems, my standards are lower. I'm still trying to get the same desired win rate in the real world, but I can have a lower threshold. It's just the way the math works. So I'm looking for 55 and 1.1. Different than the gap guide criteria. Nothing necessarily magical about that, but 55 and 1.1, if you average that, especially if all three are consistently good or at least neutral, then you've got a real good chance of a winning trade. And that was the case today in the ES, confirmed by the YM. A tad weak, 1% weak there on the YM, but profitability was good. Neutral in the NASDAQ, Russell clearly favored it. Looking at the ETFs for further confirmation, Spider definitely confirmed it, Diamonds definitely confirmed it, leaned that way in the Qs, and then clearly confirmed it in the Russell. So that 6 to 8 clearly met my criteria. One that was on the fence right there. You got to trade these, okay? So ended up being a beautiful trade, and I know many of you caught it, so congrats. If you didn't, just sort of ask yourself what kept you out of it. You may have been overthinking it, especially, and I'll give you one other last nugget, especially when I didn't fade the gap, right? When the data is as mixed as it was today, that tells you there could be some potential bullish pressures in play. That only further gave me, should have given you confidence in the long side for today. Okay, so there you go. That is the wrap for Thursday, May 2nd. Have a good one.